Hi there, good morning. My name is Victor Louis, and I'm the head of investment strategy here at Sankore Global Investments. And this is your weekly financial market roundoff. We start off in the US, where stocks edged lower on Friday as participants digested the latest set of economic data, which indicated slowing inflation and better than expected consumer confidence. The S&P slid 0.41%. The Nasdaq was down 0.71%, while the Dow lost 0.12%. Inflation slowed to its lowest annual rate in more than 3 years, with core PCE, that's the Fed's preferred gauge of inflation, rising only 0.1% month on month and 2.6% year on year. Also, the University of Michigan Consumer Sentiment Index came in higher than expected for June, rising to 68.2 from a preliminary reading of 65.6. Also, the one-year inflation outlook fell to 3% from 3.3% in May. Now, given the recent inflation data, traders are now pricing in a 64.1% chance of a Fed rate cut at its meeting in September. Market performance for the first half of the year was led by the tech-heavy Nasdaq index, which added 18.1% in the first 6 months of the year. The S&P was up 14.5%. While the Dow only gained 3.8%. Now, for the quarter, which ended on the 30th of June, the Dow slipped 1.7%, while the S&P and the Nasdaq added 3.9% and 8.3% respectively. All three indices gained in June, marking their 7th positive month in 8. The Nasdaq led with an almost 6% gain in June. The S&P and the Dow added 3.5% and 1.1% respectively. Now, for last week, the Nasdaq added 0.2%, while the S&P and the Dow were relatively flat. Going into the second half of the year, really, elections, the inflation trajectory, and also the Fed's timing with regards to interest rate cuts would prove very, very crucial in determining market direction as the AI theme, continues to hold sway. There are, however, concerns that are beginning to appear around the breadth, really, of the rally that we're seeing in the market, and this idea that stocks seem sort of frothy at these levels and could be ripe, for a pullback in the second half of the year. All of that really remains to be seen. This week, we expect PMI data and also job numbers as well. We expect the week to be sort of tepid. It's a holiday shortened one with the 4th of July on Thursday, this week. Over in Asia, China released its official PMI data over the weekend, with manufacturing PMI coming in at 49.5, unchanged from the number that we had in May, marking its second straight month of contraction. However, this data diverged from a private manufacturing survey, which was released by the S&P Caixin PMI data, which basically climbed to 51.8% from 51.7% in May. Also in Asia, Japan revised its Q1 GDP to a negative of 2.9% from an earlier reading of a negative of 1.8%. And in Europe, the political situation, particularly in France, has basically been front and center. We had the first round of French elections. Recall that President Macron had called for snap elections in the aftermath of the, sort of losses that they suffered in the European Parliament election. So the first round of the election was held, and the experts are basically suggesting a surge in votes for the far-right anti-immigrant National Rally Party. The second round of voting is scheduled to take place on Sunday, 7th of July, and would prove decisive, really, because as the first round of victories tend to, say very little about the overall result. Sunday's projections are now showing that no party has won an outright majority, and this could lead to a hung parliament and could create a period of political and economic uncertainty. Now, regardless of the outcome, President Macron will remain president up until 2027. However, he could be under pressure to elect a new prime minister, and this could create further uncertainty around policy going forward around the EU, considering the fact that France is the second largest economy in that economic bloc. Locally, the week in the fixed income market was largely bearish, particularly stemming from the increase in stock rates that we saw at the bond auction last week, where stock rates increased by about 80 basis points across curve. We saw the 2033 paper increasing by 161 basis points. So that basically spooked markets, and it created an overriding bearish sentiment in the market for the better part of last week. Treasury bills rose by 63 basis points on average, while we saw a bit of a contraction in bond yields month on month. That pretty much captures our outlook for this week and what happened last week. We do hope that you have a very, very productive and rewarding week. Thank you very much.